Good evening, Accounting 110 30240. It's our Monday class, and I'm going to record the lecture right now. I did so earlier today at our class time of noon, and it was just with one other student who really has a very good advanced knowledge of these two subjects, and we went through it rather quickly. So I thought I'd divide and conquer here, see if we can go over a couple things. I'm going to try to go through both chapters 8 and 9. Takes us to the end of the course. Chapter 8 and Chapter 9 are both about payroll. Chapter 8 is about the employee piece of the payroll. How do companies record the employee payroll? We're going to talk about that and some of the tax rules. And then we get into Chapter 9, where we're going to discuss the employer tax burden. Just like employees pay federal income tax regarding payroll, so do employers. And that's what we're going to try to go through now, okay? So I'm going to try to pop up Chapter 8 here. And I'm hoping you can see that. Let me just do it one more time here. I had a little glitch. Here we go. Okay, I trust you can see that now. And I'm going to make it a little bigger for my eyes here. Payroll accounting, employee earnings and deductions, huh? And I know most of you, I bet every one of you have been out in the workforce, huh? So you should be familiar with some of this already. And you are, whether you know it or not, huh? Payroll record keeping, payroll costs are a big expense. Gee, who didn't know that, huh? And there are laws requiring the employers to keep payroll records. This is not optional. They have to keep the records for the business as a whole and for each employee. And let's talk about the difference between employees and independent contractors, because this was an important proposition that California just voted on November 3rd. I'll talk about that in a moment and give you my opinion on it. Not that that means everything, but employer versus independent contractor. See what they're saying at the top? Secretary, sales clerk, maintenance people who come to work, factory workers, supervisors, the company's accountants, the company's salespeople. They are employees. They are considered employees, meaning that they come to work when the company says they work. They work the hours that the company assigns. They don't provide their own tools. The company provides them with a company car. The company provides them with a desk, and paper and pencils, a computer, whatever the company needs to have its employees do their job. So if you're an employee, classified as an employee, your employer is required to keep tax records in addition to the payroll and personnel records. They're obliged to take out federal and state income tax from your paycheck, and they must also take out FICA, Federal Insurance Contributions Act, I believe, which is Social Security and Medicare. An employee does not make his own hours. He has no real flexibility as to when and where he can do his work. But if you come from outside the company and you're hired to do something ancillary to the company business, maybe you needed to hire a lawyer or auditor, CPAs to come in, or you sold some real estate. These people don't work for you. They are independent of you. They are their own company, and thus you will not have to do anything in terms of taxes with them. They will send you an invoice and you will pay it, and that's the end of it. If companies had their choice, I would bet they'd love to fool around and push everybody into the category of an independent contractor, because then there's no responsibilities. The company doesn't have to worry about insurance. There's no workers' comp insurance. It's just a pure hands-off relationship. Now, the proposition that this California considered on November 3rd, you've probably seen commercials for it. It was all over the place. It was pushed by companies like Uber and Lyft. They did not want their drivers to be considered employees. They insisted through this proposition that Lyft drivers, Uber drivers, people like that are actually independent contractors. And they put a lot of advertising into this. The opposition to it was these Lyft drivers and Uber drivers are not really contractors. They, maybe they can set their own hours a little bit, but they don't say how much they want to be paid like a contractor. They're told where to go, when to pick up somebody, and they have to hew to the corporate line. So the argument was, are Uber drivers independent contractors or employees? The voters said fairly overwhelmingly that they can be called independent contractors. So this was a good gift to Uber and Lyft and companies like that, because now there's no question, at least in California, that these people are independent contractors. So that means if you're an Uber driver and you get in an accident while delivering for Uber, you are totally responsible for that accident. Uber has no responsibility at all. And like I said, some people thought it was a good thing, bad thing. I voted against it. I thought for sure these people were employees, not employers. And I also think it's a sneaky way to try to stiff the working man, if I may say it that way, by making them turn into a contractor. Employees versus independent contractor. Well, I just kind of babbled about this. If your employee, they got to take taxes out and maintain records. If you're an independent contractor, the only thing Uber now has to do with their employees is send them a Form 1099. And all that says is, dear Mr. Uber or Ms. Uber driver, you made $15,000 a year driving for me. Here you go. And then the Uber drivers have to figure out what their own taxes are and make provision to pay for them. So anyway, off the political soapbox a little bit, calculating employee earnings and deductions. Well, we need to know the total earnings. I bet we knew that already, and determine the deductions. And we subtract the deductions to get the net pay. Now, I bet you are all familiar with this. Total earnings means gross pay. And you know what gross pay means in accounting? A debit to salaries and wages expense. So when you're recording the employee payroll, your only debits will be to salaries and wages expense, or salaries expense, or wages expense. Everything else in the journal entry is a credit. So we are going to credit the amount of deductions. I like to call it withholdings. These are the numbers that came out of your paycheck that your company now has. This is your Social Security and Medicare. This is your state tax, your federal tax, your union dues, your 401k contribution, your health insurance contribution, whatever comes out of your paycheck. These are all liabilities. So you're going to debit gross pay in the form of debit salaries and wage expense, and you're going to credit withholding dash income tax, withholding dash federal tax, etc., etc. Subtract the gross from the deductions, you get, guess what? Your net pay. Net pay. Let's call that cash. Cash. Maybe salaries payable, they're going to pay you next week, but cash. So salaries and wages, this is your compensation. And they're making a little bit of a distinction between salaries and wages. Salaries are typically use the word salaries expense for non-exempt type people, meaning people who don't get paid for their overtime because they're considered managers. So compensation for managerial administrators. And a lot of these people don't get paid per week. Many get paid every other week, monthly. I got paid monthly for years and years and years. I never really got used to it. Or maybe even get paid annually. I don't know how anybody could do that, huh? Wages typically means your labor type people, your hourly people, and you're usually talking hours and weeks or units. So let's see what we have here. When compensation is based on time, a record must be kept of the time for each employee. And maybe the company collects the hours worked with time cards, plastic cards, swipes, badges or something. And the total hours are worked are multiplied by the rate of pay. Nothing you don't know, okay? Let's take a look at different types of payments in terms of when people get paid. Helen Kuzmic worked 54 hours this week. Her regular pay is $14 an hour. So she worked 54 hours. And look at this. In those 54 hours, she worked 4 hours on Sunday. Good gosh. So let's see what we do here. Well, the first thing we need to understand is she's paid 1.5 times the hourly rate for hours in excess of 8 from Monday to Friday and Saturday. If she works Sunday, she gets the double rate. So what are we talking about here? Most of you probably have heard of this, time and a half. Time and a half. She makes $14 an hour for the first 40 hours of the week. So it looks like she worked 40 and then says she worked 4 on Sunday. So that's 44. So it looks like she worked a certain amount of hours on Saturday for time and a half. Time and a half, your rate times 1.5. Your rate times 1.5. Or if you want to do it the other way, you can go 14 divided by 2 is 7 and add it, okay, double time. So let's see what we have here. We know she worked 40 hours a week and her straight time rate is 14. So 14 times 40, $560. We know she worked 10 hours a time and a half, 210. And then she had 4 nice hours at double time. So her gross pay is $882. That is going to be your debit to salaries and wages expense or wages expense. Linda, she makes $2,600 a month and she also makes overtime. She gets overtime even though she's paid per month. So to work with her, we're going to have to break her monthly rate into an hourly rate. So let's do that. Let's do that. How much does she make per month? $2,600 per month times 12 months gives her $31,200 annual pay. To get all of these hourly rates, we always need to get the payroll expressed in terms of a year, because then we're going to take the annual salary and divide it by 2,080, and that gives you 500, okay? I'm sorry, I got a little bit ahead of myself. 31,200 divided by 52 equals 600. We're then going to divide 600 by 40 to get $15 an hour. What I said was 31,200 divided by 2,080 will give us her annual rate of 15. 52 times 40 is 2,080. And any of you who go into the business world, and you're going to be working not just in accounting, but with budgets and sales and projections, 2,080 will be imprinted in your brain as the hours in a normal work year. So we figured out that 600 per week is how much she makes, divided by 40. There you go. This person makes $15 an hour. Multiply that by 1.5, $22.50 for overtime. $22.50 for overtime. So here we go. This person worked 40 hours at $15 an hour and then got 10 more hours at overtime. Added up, 825 debit salaries and wages expense. So the key thing with the payrolls that are not hourly, you must always turn them into an annual amount and then divide by 2,080, which is 52 weeks times 40 hours. Deductions. We have things called legal deductions or mandatory deductions. Federal income tax, maybe state income tax. And Lord knows we have state income tax, in California. If you don't want to pay state income tax, move to Nevada, move to Oregon, move to Florida, move to Texas. Employee FICA, Federal Insurance Contributions Act, withholding. This has two components that you're going to learn shortly: Social Security and Medicare. Right now, you guys in the workforce are paying this tax, Social Security. That's my government paid pension. I collect Social Security right now. And the people who are paying me right now are you. You. Just like when you get to be my age and well beyond, hopefully, you'll be able to collect from the people who are currently working. So federal tax, income state tax, two components to the FICA, and then voluntary deductions. I imagine if your employer is offering health care at a very cheap price for you, you would grab it. So he would take that out of your paycheck. Maybe you can have your union dues taken out. If you have a chance to get into a 401k, you would be crazy not to get into that at the full rate, okay? So we know this: gross pay less the deductions equal net pay or take home pay. How much did you take home this week is what we used to say to each other. Federal income tax required by the feds, required by federal law. And whatever the company collects from you, they have a fiduciary duty to turn that money over to the federal government on your behalf. And the amount they're going to take out of your paycheck is going to be based on how much you make, your marital status, and the number of allowances you're claiming, and the length of the pay period. Withholding allowances exempt a specific dollar amount of an employee's gross pay from income tax withholding. Whether you remember or not, when you were hired, you filled out a W-4, Form W-4. And on that W-4, you put down your marital status and the number of allowances claimed. In general, each employee is permitted one withholding allowance and one for a spouse, and maybe one for each dependent. Actually, you can put whatever you want on this thing, up to certain limits. If you're a single person, there's nothing to stop you to put down that you're married and you're claiming, say, 7 exemptions. 7. Well, that's not true. And as a result, you will get a much bigger paycheck every week. But at the end of the year, you are really going to have to pay a big tax bill to catch up. And if the federal government looks at your situation, they may say, no, this doesn't look right. And they'll come after you and maybe make you back to single zero. And I saw that done at a company that I worked at for many, many years when I first started in our factory in Los Angeles back in 1979. Employees used to change their W-4 withholding before they went on vacation to get a bigger paycheck. And they claimed like 20 people. And I told them, you can't do it. Anything over 9, I have to send it into the government. They didn't listen to me, and they all got in a little bit of trouble. Here's your W-4, huh? You put your name and address and Social Security. Married. This person is married, claiming for allowances. Perhaps he's got the wife and 3 children on top of that, okay? The wage bracket method. Okay. Here is where we're going to have to learn to read the tax tables. Now, the tax tables are in your textbook, and they should, I hope, they might also be embedded in the software, like McGraw-Hill embeds the present value tables. But if not, you just have to go to your book. Wage bracket method. Ken Eystone is married, claims 4. His gross pay is $640. $640. So find the wage bracket for $640. Find the column with 4 allowances. Remember, he claimed 4. So we're looking for the married tax table. And you're going to learn that there's a married one, a single one, and a head of household one, okay? Here we go. Say hello to your tax table. Hello, tax table. How come I was getting all excited about Zooming here. Zoom. All right, we zoomed, huh? We zoomed. Okay, notice what it says on the top: married. Weekly, you're gonna have married weekly, married monthly, married bi-month. You get the idea. There's a whole bunch of them. So when we zoom in here, see what we have. Well, we know he claimed 4 exemptions, right? 4 allowances. So how much did he make? He made a total of 630. So sorry, guys. He made $635. I'm trusting you can read that. For allowances, you keep going. He made $640. You go to the line and it says 635, 645. So this guy falls right there. So he will have to pay $10 in federal taxes. And you notice that it starts with 0 withholdings. That person has to pay more than 4 times as much tax. Next person with 134, and naturally it goes all the way down, in this case, to 0. Okay. FICA. 2 parts of this: Social Security, my pension, and Medicare, which is now my health insurance. Thanks to you. I appreciate you paying for that. And these are required deductions as per the Federal Insurance Contribution Act, FICA. So you'll hear people talk about FICA, FICA, and what they're talking about is a tax of 7.65% in total. 7.65% in total. You don't have to memorize that, but you'll be familiar with that pretty soon. And that 7.65 is broken down into 2 components. 6.2% of that is for Social Security. And everybody has to pay 6.2% in taxes until you get over $128,400 for the year. In other words, if you earned $128,400 exactly at the end of June, say, come July, you pay no more of the Social Security tax. That's called a tax limit. Medicare has no limits. So everybody pays the 1.45%. Social Security, if you make a lot more money, you actually end up paying a lot less as a percentage. And I'm going to go on my liberal, if I may, soapbox just a bit. The Social Security tax is known as a regressive tax, in that the more money you make, the less you pay. So if you make, say, $100,000, which is a pretty good amount of money, you have to pay $6,200 in taxes, okay? But if you make $1 million a year, you only have to pay about 7,000, whatever the number is on here, the maximum. So the guy who's paying 6.2%, making 128.4 or less, somebody making $1 million, well, you divide 6.20, that whatever that dollar amount is, by $1 million, it comes out to less than 0.1%. So this is called a regressive tax. I forget the word for this kind of tax, the one where it's equal for everybody, okay? So let's take a look. Sarah Cadron had earnings of $2,000. That brings her year-to-date to $127,340. Maybe write that number down, because we're going to use it in a moment. $127,340. Her earnings as of this pay date at the end of the 12th of December, she's not quite up to $128,400. So this means she has to pay the full 6.2% on the amount she earned this week. She earned $2,000 this week. So 2,000 times 6.25 is 124. 2,000 times 1.45 is 29. So the total FICA that comes out, 153. One for the pension, one for the health insurance piece. 127,340. I have to remind myself what that number is. Let's talk about voluntary deductions, huh? Savings bonds, they used to be a popular thing. It used to be a popular thing when I was a kid. You hear your parents say, oh, well, I'm putting away $5 a month in savings bonds, government bonds. Health insurance, credit unions are a great thing. 401k, very nice benefit. And charitable contributions. A lot of companies hook up with a charity, maybe United Way, and you have a choice if you want to donate $2 a week or something. Let's look at a simple journal entry. Well, that doesn't say journal entry, does it? But this is your journal entry. to record the entire payroll for the month. You debit $640. I don't care if it's out on the right here. You debit $640 gross pay to salaries and wage expense. You credit FIT withholding, something like that. Or I like withholding federal income tax, withholding Social Security, withholding Medicare, withholding health insurance, etc. These are all credits. Your only debit's going to be the gross pay. These are credits. These are liabilities. And we add up those deductions, $68.96. You're trusting your employer to make all of these payments to the appropriate agency, which leaves a net pay or cash amount of $571.04. But I'd like you to start getting comfortable with the journal entry, huh? You debit gross pay, you credit the withholdings, and you credit net pay. In other words, you debit salaries and wages expense, you credit withholdings liability, and credit cash. You can talk a little bit about the payroll records here. This is not too terribly difficult, I don't think, but the employer will have a payroll register. Guess what? They're going to have a payroll check with earning statements, and they'll have an employee earning record. The employee register and employee earning record are exactly the same thing with one difference. The payroll register includes everybody for a particular payroll. You'll see on this week that you had Adams and Barnes and Charles and Dave, you know what I mean, alphabetically, and how much they earned and how much was taken out in taxes and how much they've earned so far this year. That's the payroll register. The employee earning record is the same exact thing, except you're not going to see different people. You're just going to see you at the top of the page, and you're going to see week 1, week 2, week 3, etc. So employers must have this information: Social Security number, marital status. That's why they're required to have you provide the W-4, and they naturally have to figure out your pay, the gross pay and deductions and all that. And they have to know the tax rules. So the payroll register, that's a form to assemble the data at the end of the pay period. Since marital status and number of allowances are used to compute withholding taxes, they are recorded on the payroll register. You want to see that to check your records. And earnings are categorized by regular and overtime. So here is a look at the payroll register, okay? Payroll register. Sarah Cadrain, she had 4 allowances and was married. That's called M4, married 4. So you know when you figure the taxes, you've got to go to the married schedule and for 4 allowances. We know she made $2,000. You remember that? She made $2,000 and she had a little bit of overtime, $2,060. Okay. Now, do you have a calculator in front of you? Do you remember that number I asked you to write down, 127,340? Well, subtract it from 129,400. And what did you get? You got 1060. You got 1060. Well, she made 2,060, but you only got 1060. Why is that? Because she was only $1,060 away from getting up to 128,400, the limit. Therefore, her taxable earnings, now this is not the tax, the taxable earnings for this pay period, for this week, for Social Security purposes, is 1,060. No unemployment compensation, I guess, huh? So working with those limits can be a little bit tricky, and there are 2 or 3 we're going to have to bite the bullet and just learn, huh? Let's look at the rest of this thing. Here is the rest of the payroll register. Just imagine this was a continuous spreadsheet, okay? All right, we saw that she had $2,060 in gross pay, right? Well, 175 is going to come out of her paycheck for federal tax. Looks like there's no state tax. Social Security, this would be 0.062 times 1060, and you can check that if you like. The Medicare tax has no limit to it, so this would be 0.0145 times her entire 2060. Apparently, she's not interested in health insurance. Perhaps she has it through her husband or some other way. Doesn't want to give money to United Way. And we subtract all of those. And there is her total deductions. Her total deductions are right here. 270.59 total deductions. You probably don't need that like I do. Total deductions. So 2,060 minus 27059 net pay. And here's the check number, huh? So that's part of what we call the payroll register. And I'm going to see if I can move this up a little bit. So look at what we have here. We have the withholdings, which came from the tax table. The Social Security was 6.2% of whatever the earnings were eligible. In her case, it was only the 1,060. Her total earnings, 1.45%. And these are specific things she agreed to have pulled out of her paycheck. Here are your total earnings, your total deductions to your net pay. Total earnings, total deductions minus, total pay minus gross pay minus deductions, okay? Go back to the first one. Where did they get this information? They probably got them from time cards or pay rates or something. Cumulative total. I skipped this, and this is real important. Cumulative. Before this payroll, remember that famous number I asked you to write down? 127,340. She was at 127,340, and now at the end of this payroll, she went up to 129,400. Again, the difference between 129,400 and the 128 number is your 1060. Okay. And that is your payroll register. At this point, none of these taxes are the responsibility of the employer other than to turn your money over. You are the one paying these taxes. If you have an underpayment or overpayment, the employer has nothing to do with it. This is your responsibility. Okay. The only thing the employer has at this point is the duty to turn your money over to the proper place. Okay. Well, guess what? Employees should be paid by check or cash deposit. These are better internal controls than payment by cash. Although, I don't know if you ever worked for a place that paid cash. When I got out of college in 1971, I was immediately drafted. It was the Vietnam War era. I was immediately drafted, and no one was going to hire me for the 2 months it was going to take before the draft board got a hold of me. And I ended up working at a real tough blue-collar job, lifting 100-pound bags around all day. At the end of the week, we got paid in cash in an envelope. And by the way, I went to the physical, passed the physical, got called back again, and believe it or not, I failed the second physical for a very, very, very minor malady. So I didn't go to Vietnam. You know, sadly, almost 60,000 other people did and were killed over there. Okay, let's get rid of this here. Well, here's a paycheck. Oh, yeah, we've seen these. Well, we're back to Mr. Eyestone of Missouri. And this proud citizen of St. Louis, he had a check, net pay $571. And maybe Ken said, wait a minute, I made $640. How come I'm only getting this amount? Well, you have to remind Ken, you didn't have any overtime. You had to pay $10 in income taxes, Social Security, both sides of the Social Security, both the Medicare, the smaller piece, and the pension part, the Social Security and Medicare. You took $9, they took $9 off of that, and he had a little health insurance, and There we go. So I don't think anything this far should be too tough on us. Hey, remember we said the employee earnings record? Remember I said it was the same thing as the payroll register? Well, it is. It's the same exact bunch of columns. The only difference is instead of seeing the week on the top of the page and then all the names, now you're going to see your name at the top of the page and all the weeks. And a separate records kept information, and these records are automatically generated. So here we go. This is exactly what we saw before. No different. This person made 640. They're showing different columns of it, this different rows of it. This person made 640. And year to date, this person is up to 29,555, which means they're nowhere near $128,400. So we know that their taxable amount for Social Security is that number, 640. Accounting for the earnings and deductions, we're going to continue with the same form. The payroll register is the source for the journal entries. You bet it is. Absolutely it is. So we're going to go to that payroll register. And they did they give us a total on this thing? I don't know if they did or not. Let's go back up here. Net pay. Okay, net pay 590138. Let's see if we're working with the same numbers. I hope so. Here we go. 590138 is the credit to cash. Where did that come from? It came right from here. Total earnings minus deductions. So that's a credit. Here are your other credits. Credit, withholding Social Security. Credit, withholding Medicare. Credit, withholding health insurance. Credit, United Way. So here we are. It came right from that register we just looked at, 444-365-101, 444-365-101, 4640, okay? That's where these numbers came from. And now you subtract those deductions from the gross, you get the current, huh? So you debit the gross pay, you credit all the deductions, and you credit cash. If you think of it as your paycheck, this journal entry is really not that tough. You debit the gross pay, salaries, expense, credit the reductions, credit cash, okay? And all they're doing here, I guess, is just showing us some new accounts we're seeing, I guess, for the first time. So let's take a look what they're talking about here. All right, here's your journal entry as it looks in the general ledger. You debited revenues. I'm so sorry, you debited wages and salaries expense. By the way, I don't think I've ever seen anybody call it wages and salary. It's always salaries and wages, but that's just me. You debit your expense for the payroll, salaries and wages expense, and you credit cash for the net pay, and everything in between is a liability, okay? So I think we hit that part of it pretty hard here. What counts are involved in payroll accounting? Well, we just saw the journal entry, right? We saw wages and salaries expense, and we saw federal income tax withheld. I like that term. I don't like federal income tax payable because it's not really a company payable. It's an employee responsibility. So we saw salaries expense, your debit, your credits are all going to be withholding dash something, and you're going to have cash, okay? So you're going to withhold this money, and then you're going to pay it to the federal government. Other deductions, health insurance, United Way contribution, 401k. If you have a 401k and you're not in it, I want to know where you live so I can slap you on the knuckles. No reason not to be in the 401k to the fullest amount possible. It's not as good as the old-fashioned pension that I collect, but it's still a darn good opportunity to start investing at a young age and building up a lot of money. The person who starts investing a little bit now, say at the age of 23, just to pick a number, and continues to retirement, will probably outdo the person who didn't start till they were, say, 33, even though they threw in a lot more money than you did. It's called the beauty of interest. Different payroll keeping methods, manual, payroll processing, electronic transfer. I guess when they say manual, they're talking about you're doing it in pencil and pen, okay? Not efficient. I'm not going to say most companies, but many, many companies, including every place where I ever worked, after my first job out of college, used an outside payroll service to process the payroll. ADP is the big player. You may have heard of them, automatic data processing or automated data processing. Paychecks is a big one. There's 3 or 4 of them that kind of dominate the industry. And what you do, you hire ADP, and they provide their software. They give you a link to their software where you enter your employee information, you enter the hours as necessary, you make the changes you need in the database, if someone gets a raise or a person retires or leaves, and you hit the button to say, okay, we're done, ADP. ADP will indicate right away. They'll say something like, okay, we've got your records. And then the next day or the day after, depending how you set it up, your payroll records will arrive in the mail. You'll see all your payroll registers, and you will see the paychecks. Unless everybody's on direct deposit, then maybe it'll just come over in the form of an Excel file or something. But payroll processing center, electronic system. I'm assuming this means that the company not only pays their employees, but they use their own employees and their own software to take care of the payroll. And some companies do. And some companies really have to if it's a very complicated operation. If you have a big operation where there's a lot of departments and a lot of people moving from job to job and such, you probably do need your own, what's the word I want? What's the word? I forget the word. Proprietary, that's the word. I was a proprietary software. It belongs to you. Electronic payroll system. Well, this is, again, this is ADP probably, huh? And they're just showing you different things. So anyway, that's sort of the end of chapter 8. Now, at this point, I think I'm going to stop. I think that was enough for one session here. So take a look at what we, if you're at this point, you've already reached the end. Get that homework done and get familiar with the journal entry and try to understand the limit of the 128,400, because in the next chapter, we're going to introduce some other limits where the employer gets cut off at a certain point, okay? So if I don't see you guys before the holiday, have a great, great Thanksgiving as best you can under these difficult times. Stay safe. And my New York Jets lost again this week. They're 0-10. They not only have a chance to be the worst team in pro football by going the whole season without a loss, but statistically, they score fewer points and give up more points than the other 2 teams that also didn't win a game. However, you don't need to know that for the test. Hey, take care.